Hi, I'm Pattu from freefincal. Let's talk about many investors have asked over the years, can the Indian stock market keep falling like the Japanese stock market? Now, everybody knows that the Japanese stock index, the Nikkei 225, has been underwater since 1989. It hit a peak in 1989, and since then it's been underwater. It's had a recent resurgence in the last few years or so, but it's still underwater. Now, the reasons this happened is a topic in of itself. There are books written on this, there are treatises written on this, and so on. So, but let me just give you a layman's view of what happened. So, there was this bubble in the stock market and correspondingly in real estate, and the Japanese central bank decided to do something about it, and they decided to reduce the money supply in the economy. For example, if the central bank starts selling bonds, then it gets money from the banks and it reduces the money supply in the economy. So when they reduced the money supply in the economy and the prices came down, and the real estate prices fell as much as 70%. So many of the banks were invested in real estate, Japanese banks were invested in real estate, and they suffered huge losses. And when you reduce the money supply, the interest rates will shoot up sharply. That happened, and then the central bank decided to reduce interest rates. And when that happened, when the interest rates started reducing, and the Japanese banks suffered huge losses, what happened was the banks refused to lend to industries, and the people also started putting off their purchases. They said, well, anyway, the prices are going to fall down because interest rates are falling down, the inflation is falling down, so let's delay our purchase. So the demand dropped, and the banks refused to lend to businesses. Therefore, the supply dropped, and a kind of a stagnation ensued for a decade or more, or at least 2 decades, I would say. So, I mean, I'm giving you a very rough idea, but there are links in the article, and there are other sources which can give you a much better idea. So what you see here is the Japanese stock market without normalization, and this is normalized and in log scale compared to the Indian stock market. Will this kind of a situation happen? Will this kind of a downtrend keep happening in the Indian stock market? As a possibility, it can happen. There's definitely nothing preventing it from happening, but as a probability, we'll have to look a little more deeper. The first thing we should understand is that the stock market return is not a independent entity. The stock market is not an independent entity. It depends on so many other factors. It depends on the interest rates, the inflation, the money supply, the health of the government, the population, the rate of consumption, the rate of production. So many things factor into the stock market. So that's why people always talk about real returns. They don't talk about returns. That is, I mean, I'm talking about analysts. So if you look at equity and ask, does equity have the potential to beat inflation over the long term? Yes, that we have shown in several videos before. Yes, there's a reasonable chance that will happen, but that doesn't mean you'll get the return you want. So if you expect a real return of, let's say, 2%, and you have got a real return of, let's say, 0.5%, that means you have not bet inflation. The asset class has bet inflation. So there's a big difference. Now let's start off this comparison. The first and the most important thing is the gross domestic product. This is divided by the inflation, gross GDP divided by inflation, GDP per capita. And if you look at this, there is a huge difference between the Japanese GDP and the Indian GDP. In fact, you can't even plot them in the same scale. You need to use the logarithmic scale. And in 1989, 90 or so, the GDP was here, and you can see compared to that, our GDP was almost flat. It was almost relatively nothing. And then you can see that the GDP did not move much since then. It has been in a sideways range bound kind of movement, and that itself tells you that the stock market is not going to do well if that happens, because essentially that earnings of the companies, the government, everything, the earnings of the country, the economic growth has to show in the GDP, and then only it can show in the stock market. It's not going to be anything different. So you can see from the GDP that there's not much of an economic growth in Japan. That doesn't mean people have suffered. This is very important. Even in 1990, Japan was a properly well-developed country. I would say even in before that, people who have seen people who can speak Tamil and who have seen the MGR movie Ulagam Sutrum Valiban, that was shot in Japan. There was an expo, just like there's a Dubai expo going on right now. That was shot in Japan, and in 1971-72, you can see how developed that country was. So, they were already well developed. There was a very good infrastructure set up there. If equity did not give returns, that was because at that time there was no consumption. There was no reason for supply to increase. The inflation dropped to zero, and therefore people did not need equity. They could happily keep the money in their homes, because putting it in the bank would mean paying a penalty. The interest rate became minus 0.1% recently there. So they were very happy to avoid equity. So it doesn't mean anything. It doesn't mean any kind of disaster for the Japanese. So please understand that the Indian stock market is much lower per capita, and we have a long way to go to catch up to what Japan was in 1990. The one factor that people are worried about is what is known as the middle income trap. That is, India today has got some resources and it has got reasonably cheap labor. So that can lead to economic growth. But over time, the labor costs will also increase. It will grow. And when that happens, will India continue to be as productive as it is today, or will businesses move to other countries with cheaper labor? If that happens, then Indian economy will stagnate. That's called the middle income trap. The World Bank classifies the national income, the gross national income per capita, $1,000 to $4,000 as gross national income per capita. Any country which has got this as a lower middle class country, and India is in this kind of a band. Currently, the gross national income per capita is just below $2,000 for India. It hit $2,000 in 2020. 2020. I think the pandemic brought it down a little bit. So it took 11 years for India to go from low income country to lower middle income country, and I think it will take another 20-25 years it will take to move to the upper middle income country, that is $4,000. That is the gross national income per capita more than $4,000. So this is still a long time for it to come out of that middle income trap. It is not in a middle income trap right now, but it will take even another 20-25 years for you to classify whether India has fallen into the middle income trap or not. So there's a lot of time for us to invest in equity and make returns while we can. So this is the rate of change of the real GDP. You can see the fall in the Japanese GDP, whereas the Indian GDP has been the rate of growth has been reasonably consistent. Of course, there have been some times here and there when this is of course the COVID situation, but that's a different matter. Aside from that, it's been fairly reasonable. And this is the household consumption. This is extremely important in determining the the demand for goods and therefore the supply. You can see the household consumption has mirrored the GDP in the case of Japan, whereas the household consumption has kept on increasing in India, and it still will keep increasing considering our population and our size compared to the Japanese population and the Japanese land size. And of course, this is the population. You can't even put them in the same graph. The left-hand side scale for India, right-hand side scale for Japan. You can see right-hand side scale is 10 times lower in millions. You can see the population has hit a peak, and it has started falling down or saturated. That means that when the population is not increasing, then the demand will automatically not be there. Demand will saturate. If the demand saturates, the supply will also saturate. So there is no need for inflation. Inflation, a healthy amount of inflation is basically needed when the demand is increasing. You have a healthy amount of inflation in place so that the shops don't run out of goods because the demand is higher. When the inflation is there, then the prices will keep increasing, so that generally there's a very healthy difference between the rate of demand and the rate of supply. But in the case of Japan, the rate of demand and the rate of supply is basically the same. There's no need for inflation for them. In India, our greatest resource is our population. It is increasing happily at a reasonable rate. Of course, it's slightly slowed down here, but it's increasing. And as long as it keeps increasing, the demand will be there. As long as the demand is there, the supply will be there. As long as the supply will be there, businesses will borrow and try to generate profits. As long as the businesses try to generate profits, the stock market over the long term will be rewarding. Of course, there will be fluctuations, risks, and so on. That's a different matter. But whether the stock market will keep falling or not, I don't think that's going to happen anytime soon in the case of India. This is the inflation or the change in the consumer price index. You can see how the inflation in Japan has rapidly dropped down to zero, and it's basically oscillating about zero now. In India, it's a very healthy dose of inflation. The healthy range of inflation as defined by the RBI is about 4 to 5%. It will go down in the future. It should go down, but that's a good sign. I mean, we still have a lot of breathing space between 0% and 4 to 5%. So that will take it will take a couple of decades more than that to get there. This, of course, is the consumer price index. You can see again, if you plot it in the same scale, there's a huge difference. The rate at which the consumer price inflation is growing in India is much higher than what is growing in Japan. You can see the consumer price index has been more or less flat in the case of Japan, corresponding to the GDP oscillations, range bound oscillations, corresponding to the range bound household consumption oscillations, and so on. And this is the policy rate, the rate decided by the RBI. You can see that the rate is much higher in the case of than in the case of Japan. In the case of Japan, it's now currently minus 0.1% here, and it has been for the last 2 decades. The Japanese rate has been less than 0.5%, whereas the Indian rate has been 8%. It's been falling down from 8%. It went to 5, moved up to 8, and then it's during the 2008 crash, it fell down to 8, and then it moved up, and then it's been falling down. It's been since that time it has been falling down and has now hit a bottom of about 4%. The RBI is holding it there. They don't want to lower it. They cannot lower it any further, but they don't want to increase it anymore because they want the economy to recover. And they have been holding it, and that's an unnatural movement here. There's no fluctuations. That has happened here also in the past, but that is necessary. That's why the RBI is there to help the economy grow and so on. So as a possibility, the Indian stock market can keep falling, but as a probability, I don't think that's going to happen for the next 2 to 3, even more than that, 3 or 4 decades. I would say optimistically 50 years. That's not going to happen. The Indian stock market is going to increase. That doesn't mean everybody will make a lot of money. That's a different matter. We are not talking about risk. We are just saying, will the Indian market fall like the Japanese market? No, it will not. That the probability of that happening is extremely low. It's very unlikely for that to happen. So this is the reason why we should invest in equity and try to make the most of it while we can. The Japanese don't need equity. They are happy with cash at home, cash under the blanket. We can't do that.